Hello. On this WTI crude weekly chart, we're going to unpack one of the most confusing patterns in futures. It's called the term structure. The front-month contract and farther expiries almost never trade at the same price. Is a June contract at Darla 75, while December sits at Darla 80, or at Darla 70? That gap matters a lot. Because if you hold a position for months, or you own a futures link, that gap becomes a hidden monthly cost, or a hidden monthly gain. Today we'll see how Contango, an upward sloping curve, backwardation, a downward sloping curve, and rollover, switching contracts, actually hit your P&L. On this crude chart, compare three prices: the front month, nearest expiry, the next month, and a FAR contract. They almost never match. That pattern of price differences is the term structure, and it comes in two shapes: Contango and backwardation. Contango means prices rise as you look farther out. Think of a 3 cup of coffee that keeps creeping toward 4.50 as seasons pass. June at 75, September at 80, December at 85 draws an upward curve. Textbook framing. That slope often reflects storage and insurance costs, or the market's view that future supply will be ample. Backwardation is the opposite. Prices get cheaper farther out. The front month is rich, you need the stuff now, and distant contracts are cheap, a signal that near-term supply is urgently tight. Here's the key point. Crude futures expire. When the June contract matures, you have to switch into September. That switch is called a rollover. In Contango, say June $75, September $80. Rolling means high September at $80. Over time, that September contract tends to converge toward the front. The textbook path is 80 to 75, though real markets can diverge with supply, demand, and Fed-driven rate shifts. You bought nearby 80 and may exit nearby 75. A few dollars of loss each roll. That's roll loss. When an ETF manager repeats this every month, the drag compounds and the fund lags the spot story. Historically, in strong energy or AG Contango, roughly 5% plus annualized roll cost, about 25% cumulative drag over 5 years is a textbook scale illustration, not a forecast. So holding futures or spot-linked commodities through a steep Contango means accepting a quiet monthly cost that never shows up as a single big red candle. Now flip it. Suppose gold GC1 is in backwardation. Front month near Pila 2,400, next month near Pira 2,380. The curve is inverted. As time passes, that cheaper next month contract can grind higher toward the front. Rolling in at the lower price and out higher is a roll gain. Here, a few dollars of carry. That's roll yield, or carry, the opposite of a paycheck bleed. It can drip into your pocket when the curve is inverted. Backwardation signals, we need this now, tightness. Historically, in gold and energy, those stretches often last weeks to a few months, though it varies by asset and regime, including how real rates and the Fed shift the gold bid. For beginners, treat it as a reading, not a trade to chase. Hunting backwardation directly is complex and risky. On this copper, HG1, daily chart, here's how you actually read the term structure. Open the contract details or futures chain tab. You'll see front, next, and quarterly prices listed. Same workflow for crude, CL, gold, GC, silver, SI, and the rest. Stack 3 contracts side by side, and the spread jumps out. Upward slope is Contango, downward is backwardation. The size of that spread is your cost. Strong Contango, roughly 5% plus annualized. 캔 일루스트레이트에서 25% cumulative drag over 5 years in textbook 매수. Real outcomes move with supply shocks, rates, and seasonality. Around the second or third Thursday of the month, expiry calendars differ by product, spreads can gap. Checking those windows helps you feel how urgent the market thinks near-term supply is. 루게티시민이 나스닥 마이너스 100, NQ1, weekly. Equity index futures often cluster expiry around the third Friday of the quarter. Commodities use different calendars, so always check the contract specs. 1 to 2 weeks before expiry, volume migrates from the front month into the next. The whole market rolls at once, a cascade of simultaneous rolling. In that window, realized volatility often runs 2-3 times normal. Once flows tip, price can move fast, like a chain reaction. Retail traders should be careful from about 2 weeks out. Bid-ask spreads widen, precise fills get harder, and in a sudden stop out you may find no usable quote. On your own futures or futures chart, compare the range around those dates with quiet weeks. That week's swing will often look nothing like the rest of the month. Same story on the S&P 500 when the Fed calendar overlaps. On this S&P 500 ES1 weekly, the takeaway term structure is the hidden cost or hidden carry inside futures. If you only buy stocks and hold them, you can mostly ignore this. If you trade futures, commodities, or futures linked, you have to check it. Holding on oil or gold ETF. Look at the curve yourself. Monthly roll loss can accumulate quietly and leave you trailing the headline index, historically often on the order of a few percent a year in strong contango, not a guarantee. If your tip per return lags the spot story, remember roll drag as one possible reason. A once-a-month habit of opening the futures chain helps. This lesson is educational only, not investment advice. Futures can wipe out principal quickly. Size your capital and write a risk plan before you ever click buy.